Hello and welcome to our June edition of Personal Wealth Strategies webinar series. This webinar is going to be diving into more so investment strategy and talking about indexes. So we try to do something fun. Like last month, we talked about cruises. So definitely if you didn't check that out, you can on our YouTube page. So thank you for joining us today, where we've got myself, Ian Mindis, David Balin from Personal Wealth Strategies, going to be talking about index investing and then potentially what is even better going beyond indexes. So welcome. Thank you for joining us, whether you're here live or you're watching this on the replay on YouTube. Thank you for your time, your trust, and it is well worth it for this brief presentation today. So before we get into the main presentation and go into quote unquote beyond index strategies, what is an index in the first place? And there's a history of an index. So Ian is going to take us briefly through a quick history of the index, the most popular ones. Ian, take it away.
Yeah, thank you, Justin. So as you kind of asked the question, what is an index? Another interesting question is how many indexes are actually out there? And that's an interesting question because there isn't actually a number that anyone can agree upon. And that's mainly due to financial experts, pundits, anyone on the news, not having a universally accepted definition of, what an index is, what a large cap, small cap. There's no defined definition. So they don't actually know how many large cap US indexes there are. So you're not going to see that number. But just for our sake of argument, there's 7 US large cap indexes that are really widely known and widely tracked. And these are starting with from the most popular kind of down, the S&P 500, S&P standing for Standard & Poor's, and that tracks the 500 of the largest US companies by market cap. The Dow Jones Industrial Average, that's the 30 large blue chip US stocks, and those are price weighted, and I'll get into kind of those, what those mean later on. The NASDAQ 100, and that's 100 of the largest non-financial companies listed on the NASDAQ exchange. And this is widely known that this is more of like a tech-heavy index because a lot of the largest non-financial companies are going to be tech companies. Think Apple, Microsoft, NVIDIA, companies like that. The Russell 1000, and that's the top 1,000 stocks by market cap that Russell has evaluated, and that's kind of both large and mid cap, but it's mainly gauged as a large cap index. Then there's the CRSP US Mega Cap and CRSP US Large Cap indexes. Those are used by Vanguard and many of their funds for benchmarking. The MSCI USA Large Cap Index, and that's often used for institutional companies benchmarking. And then there's the FTSE USE Large Cap Index, and that's used by funds from iShares, which is BlackRock. So starting with the S&P 500, and I'm only going to go through the S&P 500 and Dow Jones Industrial Average because they have the most rich history, the most interesting history than any of the others. And a lot of these other indexes kind of use the same strategy to come about as the S&P and Dow Jones did. So the S&P 500 is currently actually controlled by Standard & Poor's Dow Jones Indices LLC, and not surprisingly, Dow Jones is controlled by the same company, Standard & Poor's and Dow Jones Indices LLC. And that's a joint venture primarily owned by a company called S&P Global, but they just essentially run those indexes and provide the resources to evaluate it from time to time, add companies, take companies out. And so the S&P 500 draws its history all the way back to 1860, when a man by the name of Henry Varnum Poor, he formed Poor's Publishing, which published a guide for investors in the railroad industry. Then flash forward all the way to 1923, a company by the name of Standard Statistics, they began rating mortgage bonds, and they established their first stock market index consisting of about 233 US stocks. Then in 1941, long after poor Henry Poor had passed away, his company merged with Standard Statistics. And by March of 1957, the stock market index was expanded one last time to its current level of 500 companies. So it draws its roots all the way back to 1860, but the actual index itself, the tracking of it didn't start until the early 1920s, really. So if you want to go back to the oldest, not the oldest index ever, but the oldest kind of index that was tracked is the Dow Jones Industrial Average. which was first composed in 1844 by a man named Charles Dow. So that makes it one of the oldest calculated indices in the world. And he composed his first stock average containing 9 railroad companies and 2 industrial companies. Now, what is an industrial company? That just meant it wasn't a railroad company at that time. So it's just a regular US company. But then in 1886, Charles said, you know what, let me split these 2 indices. Let me track only railroad companies and then track all the other companies. So the railroad indice became the Dow Jones Transportation Average, which is still around today, tracking purely railroad and transportation companies. And then the other index in 1896 became the Dow Jones Industrial Average, which is the index that we all know and love today. And so when that was formed in 1896, I want to go through 3 of the 3 companies that were in that initial bunch that might stand out. The first is the American Sugar Refining Company, and this would go on to become Domino Foods. So if you think, when you go to a restaurant, get sugar packets for your coffee, it says Domino on it, or you get the big tub of whatever amount of sugar, that company was still around back then. Then United States Rubber Company, that would eventually be bought out by Michelin in 1990. So when you're driving, just know the company that made that draws its roots all the way back to the 1890s. And the most interesting one was General Electric. So that company's still in existence, same name today, and it was only taken off the Dow Jones Industrial Average in 2018. So the big difference between the S&P 500 and the Dow Jones Industrial Average, besides the amount of companies, S&P has 500 companies in there, Dow Jones only has 30, is how they're actually weighted. So the S&P 500 is market cap weighted. So the bigger the company, the more the share of the index they have. So Apple, I'm not sure, Justin, you can tell me, is NVIDIA or Apple the largest company today? It changes every single day, but let's just say, for example, Apple is the largest company. So Apple is going to have the largest share in the index, which is probably around somewhere of 6-7%. Turn it over to the Dow Jones Industrial Average, which Apple is also in that index as well. Apple only accounts for about 3% of that index, whereas a company like Sherwin-Williams, which they're a big company, they sell a lot, they do a lot of paints and things like that, but they're not nearly as big as Apple, but they have a almost 6% share in the Dow Jones Industrial Average. That's because it's price weighted. So the price of Sherwin-Williams stock is actually more, even though the company's smaller than Apple. So that's kind of a nice brief history of our oldest and most well-known indexes. Justin, I'm going to throw it back to you.
That's awesome. And actually, live today, Microsoft is taking over the #1 spot. NVIDIA is #2, Apple #3, and they've flip-flopped. All of them are over $3 trillion in terms of size and market cap. So massive, massive companies. Apple took the lead for a while. Now, NVIDIA, I think last week, and now Microsoft this week. So it just continues to flip. But the question is, that's all interesting history, but when did indexes actually get to investors? Because when you look at investing, the far majority of the time back in, that time, the 20s, 30s, 40s, 50s, 60s, if you were investing, most people weren't, but if you were, it was all in active strategies, meaning there were investment managers that were going to pick whatever stocks that they think were going to outperform and give you the best value, the best return. It wasn't until 1971, actually coming from none other than Wells Fargo, to introduce the first index fund. A lot of people, if you ask that question, would be like, oh yeah, Vanguard, definitely. They're the leaders in index funds. They definitely introduced the first index fund. Well, that's true. That was on the retail side. So Wells Fargo, they actually did it in 1971 within Samsonite's 401k retirement plan. And so their retirement plan was the first index fund that was available to investors. However, the retail didn't get until a couple years later. And Wells Fargo actually gave the research behind the building of the index fund to none other than John Bogle, which took it and introduced it, creating Vanguard's first retail index fund in 1976. And after it was created, it was a wild success. Actually, it wasn't. Index funds were very rarely used. Actually, when they first came out, the index fund was known as Bogle's Folly because it was that unsuccessful. Now, fast forward to today, as more people have adapted and adopted to the research, Vanguard manages $10 trillion. The far majority of that is quote unquote passive, tracked to various indexes. Little known fact, Vanguard actually does have active managed strategies that they do as well. Only about 15 to 20% of their overall assets under management is in active strategies, so far passive. But the index OG to retail investors, John Bogle Vanguard, that happened in 1976. But there's some more history there. David, take it away.
So the index fund is created as part of Samsonite's retirement plan. And what happens is the researchers who came up with the index fund realized immediately that there were some problems with investing in indexes or tracking an index as part of your investment. And what happened? The researchers then left and became part of the founding partners in a company called Dimensional Fund Advisors, or DFA. And DFA built the company along the ideas of asset class investing as opposed to index investing. Asset class investing looks to address the investment question in a way that indexing didn't. And that's what today's presentation is going to be on. What is the difference between indexing and some other technical ways of investing that are not quite active and not quite passive? So before we go into this, Justin, let me take a moment and talk about the difference between active and passive, because we'll throw those terms around, but just like index, they can mean different things to different people. So the names here, which surprisingly for finance are actually pretty descriptive. Active management would be an investment strategy where a human being, typically it's a human being. Nowadays we have artificial intelligence too, but a human being is deciding what stocks, bonds, real estate, what holdings to buy and what to sell. And they're making those decisions with the idea of producing a result that beats the market, beats the index, beats whatever they're benchmarking against. So an active manager is trying to outdo the competition. A passive strategy, and here I'm going to use the word passive to mean purely passive. A passive strategy is one in which a collection of securities is developed and there is no management going involved in terms of decision making as to what securities go into that pool of assets. It's typically done on a rules-based basis, meaning that the algorithm is already determined what goes in and what goes out, and no human being comes in between. And as you can imagine, between those two extremes, there are now a lot of other different options available. And that's what we'll get into a little bit as we go forward today.
Yeah, and that's the great point, because the question then becomes, as we kind of talk about index funds, and we usually have them synonymous with passive, but are they truly passive? And if you look at or listen to the history of the indexes, well, the index providers decide what goes into the index, and a human committee writes the rules for the index. So although they're not looking at necessarily, Coke, Pepsi, which one's better, like a truly active manager would, they are deciding the rules for the index, what gets adopted into the index, and the timing that it gets adopted into the index. So it is active strategy, active decisions that build indexes. So is an index actually passive? I mean, it's probably pretty close to a passive strategy as you can make, but technically speaking, there are active decisions being made there. Ian, David, you want to add anything to that?
Yeah, I'll throw in the first active decision that's made is which one of these indices do you choose? So Ian said there's 7 different widely accepted indices that focus on U.S. large companies, right? But why are we focusing on just U.S. large companies? What about foreign large companies? What about small companies? So you have to do that, and then I got to choose, and let's just limit it to 7. Although, as Ian said, there's more than that. Do I do the S&P 500? Do I track the Dow Jones Industrial Average? Do I track one of the other indices? That first decision that you make determines whether you have 3% of Apple or 6% of Apple. That's a pretty big decision.
Yeah, and one more thing I want to add too is a lot of these indexes hold the same companies. So a lot of the time, people actively thinking I want to diversify, they'll buy different indexes from different companies. So S&P offers, S&P 500 has an index and there's a fund for that. Dow Jones Industrial Average has their index, there's a fund for that. Let me purchase both. but they actually own the same company. So you're just getting more of the same sometimes.
Yeah, that's interesting. And although it's, the same companies a lot of the times, there's different mixtures of those companies. And so you can have, different performance based on that. And so each index you can kind of look at as a different recipe. And the way they, create and build that recipe is different. So the S&P 500, which Ian has talked about a lot, consists of those 500 companies. The S&P 500 committee, the humans again, they select what does get introduced into the S&P 500, what doesn't get introduced. It is not just based on size, as an example, and we'll go through that in a little bit. And then you have others like the Russell 1000, which is mechanical. It's just that it is the top 1,000 companies by size. And so all of these different committees, the S&P, MSCI, FTSE, Russell, what Ian was talking about, the goal is not necessarily for investor returns, though. The goals of these committees and the indexes themselves are not actually designed for investment. It's designed for market representation to give us a good idea about what the market in general is actually doing, not necessarily as an investment strategy. So if the goal is market representation, not investor returns, should we even be using them for investment? That's a kind of separate question. But active choices definitely contribute to the indexes, but then those rules are followed consistency. And there's good things about indexes. The good things about indexes that we'll go through overall: low cost, diversification. If you look at the research, they far outperform the majority of the time active strategies. They're tax efficient. They're simple to understand, and they just follow the general investment principle rules. But then the question becomes, as David was saying, can we take the core research of why we love index funds and why they're good and make them a little bit better? Anything else to add to that, David or Ian?
Yeah, one of the things that's interesting here, Justin, is I did a little research on this because although our slides are going to focus on domestic US-based indices, for a lot of investors, the question becomes really, where should I be investing my money? And a lot of times people will come to us and they'll say, how is the market doing today? And I'll say, well, what do you mean by the market? And they go, the stock market. And then we'll say, well, what do you mean by the stock market? Well, they'll say, well, I was watching the news, and on the news they said the S&P 500 is up today or down today, or the Dow Jones is up today or down today. But if you think about it, the Dow Jones Industrial Average represents 30 different stocks. The S&P 500 represents 500 stocks. But that's 500 stocks of approximately 4,500 stocks that are publicly traded within the US. 500 versus 4,500. Well, why don't we track 4,500? Well, going back to the history lesson that Ian gave us, before we had computers, can you imagine trying to track 4,500? I'm the guy in the meeting here who has the gray hair. I can tell you that when I was in college, I remember going to the basement of the library and pulling out microfiche, pulling out Wall Street Journal, and looking up the stock price of different stocks. Not a lot of fun. All right, so we got 4,500 stocks sold here domestically. What about internationally? Well, if we add the developed markets, that adds another 6,400 stocks. If we count the emerging markets, that adds another 8,600 publicly traded stocks. You put them all together, that's roughly just shy of 20,000 different stocks. So when I turn on my news and I hear the S&P 500 stocks are up or down, that's 500 out of 20,000, or about 2.5% of all the stocks available. So is the S&P 500 representative of the market? Probably not. It might be representative of those 500 companies, but it's not the market.
Yeah, one thing I want to add is a question to the both of you. Do you know the index that tracks all of the companies within the US stock market?
The total index?
The Wilshire 5000.
That's correct. Yep. Just wanted to keep you on your toes. No, but that is actually the index that encompasses all the publicly traded companies within the US. And the fact that it's not known whatsoever, because that is, if you want an actual accounting of what is the total US market doing, that's the index you should be looking at. But it includes all the good companies like Apple, Microsoft, Nvidia, General, all those big companies. But it also is going to include all those really small companies, penny stocks, even if they're publicly traded, that you necessarily don't want in your portfolio, who have horrible earnings, no revenue, a lot of debt. So that isn't nearly as tracked as much as the S&P 500 and other big large cap indexes like that.
Yes, I appreciate the quizzing, and that was not planned, people. So that came off the top of my dome. Thank you for keeping me on my toes, Ian. So this question of indexes and like, are they truly passive, as I was alluding to? Well, let's look at an actual example of a stock. And Tesla. Tesla, obviously all over the news today and has been over the news for a long time as it's continued to solidly grow. But when it was eventually introduced into the S&P 500, it wasn't until 2020. And at the time, it was the sixth largest company when it was actually introduced. So going back to 2013, it grew massively, but it didn't actually have the profits. It didn't have the positive earnings. And that's one of the rules, the requirements of the S&P 500 committee to be introduced into the index. And although it had a very large market cap, it was a very large size, it didn't meet that profitability requirement. So in January of 2020, it started out that year as the 60th largest company, but wasn't introduced into the S&P 500 yet. So that's how we know definitely that the S&P 500 isn't just the 500 largest companies, because it didn't include Tesla at the 60th largest company. But it's interesting, in July of 2020 is when positive earnings were first reported from Tesla. And so that was good news, because now that was kind of the last check mark they needed in order to satisfy inclusion into the S&P 500. However, that happened in July, and it wasn't introduced officially until December. So there's a lag. Why the lag? I don't know. You have to ask the committee. Maybe they were waiting to see if it stuck, but that's what they decided. And now what's interesting is, typically when they're going to introduce a new stock into the S&P 500, they give a 5-day warning. So they say, in 5 days prior, on this date, 5 days from now, we're going to introduce this into the S&P 500. But this time, it's interesting, they broke the rules. They broke their own tradition, their own rules, and actually announced it approximately 34 days, a month in advance of inclusion. So in November of 2020, they announced that, hey, we're going to include Tesla in the S&P 500. Good news, everybody. And what this signals to investors is, well, all of these investments that are tracking the S&P 500 need to buy Tesla. And because they want to follow closely to the S&P 500, they're not going to buy it until it's officially included in the index. And so what happens now is that now active traders are seeing that and say, wow, billions of dollars now need to flow in and buy Tesla. What are they going to do? They're going to front run and they're going to purchase it. So from the time it was announced that Tesla was going to be included into the index, by the time it was actually included in the index, there was a run up of 71%. There was a 71% gain in Tesla stock between the announcement and when it was officially included into the index. And then what do you think after it got included into the index? It naturally fell from there. After the addition, it falls about 7% in the first days. So not only did index funds that were solely tracking the S&P miss that run up, but then they also, after they got in, also included a downward trend in Tesla after the addition. And this doesn't just happen in large stocks, it also happens in small stocks. So Ian, why don't you take us through a small stock story?
Yeah, because we're talking a lot about the U.S. large cap indexes; those are the most well known. And also with Tesla in particular, that situation, that was a stock going into an index. That was a potential risk of a stock going into it. Is there any risk if a stock's already in the index? Well, if anyone's familiar with the story of GameStop in late 2020, early 2021, where a bunch of retail investors poured into GameStop, squeezed the short sellers, and the price rose dramatically, that wreaked a little bit of havoc on the indexes, because for many years GameStop, which it was a declining company, their earnings were low, and they were part of the Russell 2000 index, and the Russell 2000 tracks the 2,000 smallest companies in the Russell index. So you have the Russell 1000, the largest 1,000 companies, then the Russell 2000, the smallest 2,000 companies. So GameStop, which was part of the Russell 2000, all of a sudden their price rose so much. There was so much money in the company. It actually, became a mid-cap stock. It was no longer a small-cap stock. And so, but due to the index rules, because a lot of indexes are not adjusted, actively, they don't look at it and say, "Oh, these companies are now no longer, small cap. Let's get those out of there." They only make adjustments. The Russell 2000 specifically, other indexes have their own time frames. They make adjustments only on an annual basis, and they only do it in June each year. So GameStop had risen dramatically in January. Their price rose crazy. Their market cap was crazy. They were no longer a small cap stock, but they were still held within the Russell 2000. And if you're in a fund that's tracking the Russell 2000, you were still holding GameStop, no matter whether it was a mid cap, large cap, mega cap. It was still within your investment. However, June of that year, GameStop was still technically a mid cap. It was no longer a small cap, but the price had dropped pretty significantly from its high in January. So that means if someone's invested in a small cap fund that's tracking that fund's not making the adjustment, and they're having less of a return than they should have otherwise received in that fund, had that been invested using a more academically based active approach, adjusting the investment on some sort of academic merit, some academic research showing that this is no longer a small cap stock. It's grown. Let's sell off that portion, capture that gain, and move on. But that's a potential risk of holding that index for a company that's already in the index. And fortunately, unfortunately, that story kind of still remains. GameStop is still an elevated company because there's so much going on with it. But anything, Dave, Justin, you want to add to that story? Any personal stories that you've heard from that?
It's not just GameStop. I mean, that's an example,
Yeah.
but there's other companies, the meme stocks rather, kind of go through a rotation and look to take advantage. And investors, the message here is that investors know what indices are going to be doing. I often describe investing in an index a lot like playing poker by turning over all your cards. You might win if you get dealt the right cards, but if everybody else knows what you're doing, chances are you've reduced your odds.
Yep. And so the question of indexing in your portfolio, is it aligned with your goals? Potentially. I mean, indexing is definitely not bad, but we have to go back to the rules and the point of the index being market representation, not being investor performance. And so if you just want to mirror the index exactly, trying to minimize your tracking area, trying to just achieve whatever the index achieves, and typically over time, if we look at the S&P 500, look at other indexes that take market risk, they do grow over time. So it's not like these are bad investment strategies, but there's a potential mismatch because it's kind of a one size fits all indexing. Yes, you have the low cost. Yes, you have diversification. But as we've just been discussing, there's some other areas where indexing has some downsides. So what if you could get all of the benefits of the indexing and fix those other friction points, like the ones we were just talking about from the individual stock related story? So that's what we're talking about here, is keeping the benefits, the diversification, low cost, the simplicity, but those rigid rules, those hidden costs, like what the heck? What's a hidden cost in an index fund? Well, we just talked about it. By not including Tesla and including it later and then missing a 71% increase and a 7% downturn, that's not a cost per se that you see in a fee, but that is a cost that the investor missed out on from not gaining that rate of return. So what are rules-based strategies with proven track records that have the diversification, have the low cost, have the simplicity that we can actually track and obtain? Do they exist? Is it out there?
Hey, Justin, before you go on, I want to go back a moment on that last slide. We talked about the hidden cost of Tesla.
Yeah.
The hidden cost of Tesla isn't necessarily just that you missed the 71% growth. How about the fact that you paid 71% more for that same stock than you could have? Does that sound like a good deal to anyone?
No,
That's why people join the webinar for advice like that.
Yeah, there you go. Well, and it's funny you mentioned that too, because there's other if you just look at the quote unquote normal investor who's looking at selecting an investment, one of the things that they immediately look at is, well, how has this been performing recently? And so that begs the question, is that a good investment strategy? Clearly no, because you're paying way more for something. But that's how investors emotionally sense it. Like if something's going up, it's like, wow, I need to get into that. And if something's going down, it's like, whoa, like there's something wrong with that. Let me sell it or stay away from it. When in fact, if you're investing on an asset class basis, you want to do the opposite of that. And so that's very, very interesting. And so looking at what the proven strategies are. Number one, rooted in the academic research, going all the way back to Wells Fargo and the Nobel laureate research there of several different people, including David Booth, the founder of, was one of that team, founder of Dimensional Funds, that David talked about. Real track record. So Dimensional, even Avantis, which is a newer company, but a spinoff of Dimensional, they utilize a lot of these same strategies, maintaining lower cost because it doesn't require that much more to have these investment selections once you set up the appropriate rules, but you need to be disciplined. You can't have a manager that's going to be distracted by something superfluous. They need to follow and maintain with the rules and the evidence, but what's they need is that trading flexibility, the ability of not being strict and like the Russell 2000 and saying we only change it once per year. You can have a more fluid strategy. And one of the kind of best visuals for this is, when you look at doing something once per year versus a little bit every day, like what do you think would be better? Brushing your teeth a little, 2 minutes in the morning, 2 minutes at night, a little bit every day. Or if you just brushed your teeth for like 24 hours straight, just one day, and then didn't brush your teeth the rest. Clearly the answer, and clearly the things I hope most dentists, if you're on this call, would recommend, is a little bit each day. And so that's how we view investment strategy, not an index that's just going to reconstitute and do that transition once per year. David, Ian, anything to add to this slide?
No, one of the things that becomes difficult, Justin, is if you're invested in an index, how do you know if you're doing well? Right. So if you're invested in the S&P 500, I'm going to pick on the big guy because everybody knows it and sees it on the TV, and you're invested in your S&P 500 index fund and you're up 1%. Is that good? Is that bad? I don't know, because the only way I'm going to measure it is I'm going to turn on the news at night and hear the S&P 500 was up 1%. I'll say, oh, I'm up 1%. That's good. But if you invest in one of the other indices that Ian mentioned earlier, would I have done better? In 2025, I will tell you that you would have done a lot better if you invested in international stocks instead of just domestic stocks, because they're having a better year. But that's not going to come on in the news. So you need to really decide what is, and go back to the last slide, what it is that you're trying to accomplish, and go back to that evidence-based strategy and develop something that's going to work for you personally.
Yeah. So what's interesting, so now that we're getting this information, we're going to go into a little bit of like what that evidence is. We don't have a deep dive into that. And if you're interested, you can definitely research more on your own. But first off, when you're looking at investments, understand your options. So you're not limited to just index funds, but the question is, what other funds do you want to go into? Because high cost, actively managed strategies typically are not going to work out. And so you don't want to go that direction, but don't just restrict yourselves to index funds because you believe every other strategy is not good. That is definitely not true. So what are those different rules-based strategies that are going to fit your goals? And one part of the story of Dimensional that David didn't specifically mention is that they got their start not even in the large cap space. It was actually in the small, or what we now call micro cap space, because what they realized was that there was a lot of these different strategies that were focusing in on the large cap space, but the small cap space, there wasn't really an investment that you could make into them. There were only active strategies. And when they created their fund, there wasn't even an index for small companies. And so they couldn't really track an index. And so they just kind of made their own. But that's how they started it at their core. And so when you look to take action in your portfolio, starting with index funds is not a bad strategy for sure. It's better than just guessing. So start with the index funds, but then start to explore different things and take action you can discuss with an advisor and implement gradually, further diversification of what these strategies could look like. David, Ian, anything to add there?
Nope, we're good.
All right. So the question is now, what are these factors? And what's fascinating is we look at an investor like Warren Buffett. And Warren Buffett, has outperformed the market. There's no question about that since he started Berkshire Hathaway. But what did he do that caused that outperformance? And it actually isn't so elusive as one might think. And yes, he found the strategies, he implemented and got the results. So I'm not discounting that at all. But if you look at what he actually did, meaning investing in lower priced companies, in more value oriented companies, investing in smaller type companies, he and actually using some leverage as well, using borrowing to fund those purchases. All of those sprinkles and strategies are within the research where they actually should outperform. And that's when we talk about the 5 factors here of investments, including all of them to get a little bit of improvement and compounding over time. So number one, you have the just market factor. A market-based investment is going to outperform your treasuries, bonds, fixed income, just because of the increased risk you're going to take. And most people, that's where it started. And most people thought market risk was market risk. It didn't matter what types of companies you had. But as Warren Buffett showed, it actually does matter what types of companies you have. And so smaller companies are going to outperform larger companies on average because you're taking more risk. That's the second factor. The third factor, lower priced value companies are going to outperform more growth oriented companies that are trading at higher prices. The fourth factor, profitability. Profitable companies in general are going to outperform companies that aren't profitable. And then the fifth factor, investment, and how you look at investment within a company and how Dimensional actually utilizes it is by exclusion. So for example, smaller companies with very, very high investment are actually going to underperform. And so they tend to exclude those companies. But that's another factor of return. And by mixing and matching all of these different factors, and Dimensional has actually done this. So this isn't just in the textbooks. They've actually proven this strategy out. And what we're not doing here, I want to reemphasize, is we're not looking at these past 20 plus years of performance from Dimensional and saying that's going to continue just because they were better than the indexes or the markets. We're looking at it and saying, well, there was a academic research, there was a hypothesis, and then it was now proven over these past couple of decades. And the expectation is that it will continue in the future. So this isn't speculation. This is expectation because it's evidence-based. We're not making risky bets. And that should give you some comfort and some knowledge to say, all right, going beyond just indexing, including all the good stuff, and then sprinkling on some more of these factors, this evidence-based philosophy is going to make our investments great, not just good. David, Ian, anything else to add as a final?
What I'll throw in here, when you're looking at those 5 factors, Justin, one thing that's really critical to consider is this is over time. It's not on a short-term basis. So while we can say small company stocks outperform large company stocks over the long term because of their greater risk level, you can't say that every year small company stocks are going to outperform large company stocks. In fact, you would find many years small company stocks don't outperform large company stocks. So if you're trying to be a speculator, is the term we use, someone who's going to get in and get out, these factors aren't going to be important to you. But research is also going to show that the more you get in, the more you get out, the less likely you are to have long-term growth. But if you're looking at things over the long run, you're going to say, I want to follow these factors that have been academically proven rather than do the exact opposite. And the way I'll back this up with Dave's research, we'll call it, is I like to joke that if I go to Atlantic City or if I go to Las Vegas and I go into the casino, there's only one bet I want to make. And unfortunately, they won't take the bet. You know what that bet is? I want to bet that the casino is going to win. Now, do they win on every roll of the dice? Do they win on every hand of blackjack? No. But over the long run, those odds become in their favor, and they're going to prove that they're going to win. When we look at investing, it's the same thing. We say, do I want to bet that small companies are going to grow and produce profits? I am. Maybe not every company, not every year, but I believe that that's going to happen over the long run. And therefore, when I'm trying to develop a long-term investment strategy, I want to have just that, a long-term strategy. And I somewhat have to close my eyes to the short-term fluctuations because there will be.
Yeah, kind of to mirror and piggyback off of that, because that's exactly what I was going to say, David. But in terms of developing that trade, once you've put together the research, your own research, you have a trusted advisor, a trusted professional who's helped you, put together this strategy. It's important to stick with it because, as Dave said, over the long term, that's where you're going to see that evidence-driven results. And the only time you should look to make any sort of changes when there is actually like a lifestyle change, something that you're going to want to think about. Should I take some risk off of my portfolio? Should I add some risk? That's the only time that you should look to change these strategies, is when there's something going on in life, your lifestyle is changing. But it's sometimes it's really hard to take the emotion out of it. That's emotion is not a lifestyle change. Just because one year perhaps large caps are going to outperform small, doesn't mean we need to get rid of all those small caps just because they underperformed one year, because the next year it might be the opposite, and you don't want to miss out on that growth.
Yep. And the good news, if you're a client of us on the call, we do this already for you. You don't have to worry about it. If you're not a client on the call or watching this in the replay, and you want to get a review of your portfolio to see how it aligns with these strategies or not, how it aligns from a cost perspective, a diversification perspective, taking advantage of these factors, we will do a complimentary review of your portfolio strategy, what we call a gap analysis, from kind of where your portfolio is to where we would ideally see it from a utilizing the diversification, the factors, the low cost that we have in our portfolio, and how big of a gap you have and where that is. So we'll offer that complimentary to you today. If you're on this call, not a client, I just put a link in the chat to schedule that consultation. In advance of that consultation, we will look to get your investments where they are, the different ticker symbols, to be able to include that in the report. But if you click the button, book the call, we'll be able to follow up to get exactly what we need to run that report for you with no obligation, no cost, completely complimentary, just to show you where there might be some gaps in your portfolio, so that you can then take that information and either implement it yourself, or obviously, we'd be happy to talk if that would be a potential right fit for us to work alongside you to implement those strategies. And so that's an active approach today that you can take, not with your investments, but with your financial planning. To schedule a call with us, click the link, fill out the info, and be able to schedule a time where we'll be able to actually take a look and snapshot in your portfolio. David, Ian, any final before we wrap it up today?
Yeah, I'll leave you with one thought and one reminder. All right. So the thought is, you can either have the evidence working for you, or you can try and work against the evidence. I would say I'd want to implement what is known and make sure it's working for me, and not try and beat the odds. And my reminder is that we do these webinars on the first Wednesday of every month. Next month will be on July 2nd. I know everyone's going to be packing up for the July 4th weekend, but before you pack, you may want to join us on July 2nd at noon for our next webinar. And make a note to join us every noon time on the first Wednesday of the month. Of course, these are all recorded and will be posted on our YouTube channel. So if you don't, or if you're not able to watch us at noon, you'll be able to see the replay. Or perhaps even if you did join us, you may want to say, well, that was really good. I want to make sure I captured everything, and go back in and see the replay.
Awesome. Thank you, David. Thank you, everybody, for joining us. And we will see you next month.